This conference will now be recorded.
Welcome everyone. It's 12 noon on the East Coast and 9 a.m. on the West Coast. Welcome to the Anpa webinar series number 7. Today we have a whole bunch of things to cover. I'm Stanley Okoro. I'm the current National Treasurer for Anpa. I'm right here in Atlanta, Georgia. And so let's get started. Dr. Kunseri, can you see my slide? Dr. Chris is online. I don't know if Charmaine, our current president, is online. I don't see Charmaine. So Chris, as the president-elect, can you take, just kind of introduce AMPA to us?
Thank you, Stanley, for this opportunity. And on behalf of the Association of Nigerian Physicians in the America, I want to thank all the presenters and welcome all the invited guests here. As you all know, AMPA is a 501c3 organization. We are over 25 years of age and we continue to increase in number. We represent over 4,000 physicians, dentists, and allied health professionals of Nigerian descent, and I'm glad that we're able to have this opportunity to continue to share things that are pertinent to our membership. Thank you very much, Dr. Okoro.
Thank you, Dr. Okunseri. This, for some of our members, some of the member benefits that AMPA provides to its members: professional development, leadership opportunities, practice referrals network, and of course, volunteerism opportunity. So without further ado, let's just jump into what we have 2 segments to cover today. The first one will be presented by Dr. Ikenna Nwamba. He's going to talk about innovative payment models for private practice. Following his presentation, Enyi Kanu and his team, Rick, Jay, and Jeremy Hirsch, will present selling medical practices, challenges, options, and tax-effective solutions to us. So that will be the order of presentation. And just before we get started, AMPA disclaimer: the materials presented at all of our webinars is for general information purposes only. The webinar is not intended to provide any personalized or legal advice. It's left to your discretion and judgment, and it's your sole responsibility to determine what is necessary for your own practice. Neither the speakers or AMPA can be held responsible for the materials, opinion, or any inadvertent error or omission in the preparation or presentation of the material. Furthermore, nothing in this material should be construed as an endorsement by AMPA. All right. I'm going to go to you next. In 1 minute, let me load up your slide, okay?
Sounds great.
All right. Okay, Dr. Nwamba, you can take it from here.
Sounds great. Okay. Hello, everyone. Thank you for joining us today. I will be speaking on innovative payment models for private practice. My name is Dr. Ikenna Nwamba, and I'm a physician executive at Genthem. I'm internal medicine trained, and much of this material is relevant, especially in light of the recent COVID-19 pandemic. Next slide. So just to kind of lay a bit of a foundation, COVID-19, the pandemic has really forced us to practice medicine differently. And that's because we've seen an abrupt decrease in the number of in-person visits. From a primary care standpoint, we've seen a reduction in revenues up to 30% because of the lack of opportunity to vaccinate, do labs, or do other in-office procedures. That has really forced private practices to adapt. New healthcare policies have emerged, and that has really impacted how we're going to be practicing medicine from here on out. Ultimately, much of the conversation has been around telemedicine. However, there also have been interventions in place which have been designed to improve the cash flow predictability of private practice, especially in light of the recent cash flow dry up. Next slide. So ultimately, this is very important for physicians because the COVID-19 pandemic is not over. Ultimately, you as a private practice physician have to now think about the potential of hotspots emerging and other pandemic possibilities that might involve recurrent geography-specific physical distancing mandates. So with payment model innovation comes the opportunity to protect the financial viability of your practice. So understanding these payment models is going to become more and more relevant and important for you. Next slide. So let's just kind of go through 4 of the most popular value-based payment models. Capitation, which ultimately is getting paid a fixed monthly fee for services rendered. Further, shared savings is the opportunity to gain share when physicians come together and reduce costs. Those bonuses are usually remitted at the end of the year. Bundled payments speaks to episodes of care that involve multiple providers, and those providers are uniquely incentivized to reduce the cost of that episode of care and are paid in accordance with that sort of agreement. And finally, pay for performance, a model that's really used to give providers an incentive to perform along metrics including patient satisfaction, quality, and cost effectiveness. So that's a quick review of the existing value-based payments. Now, think about how that context, that background of innovation is now met with recent payment reforms that were initiated through the CARES Act. So where we saw a reduction of in-person visits, there was an opportunity to receive accelerated or advanced payments. CMS initiated this. They had $175 billion allocated or earmarked for this initiative. And within a month, that money dried up because of basically overwhelming demand. In addition to accelerated payments as an opportunity to protect your cash flow, you have prospective payments, which are now becoming a hot topic in the community because doctors really want to find that stability that they were promised, at least in the private practice world as well. And the notion of prospective payments is an agreement to get paid based on known costs that the patient may incur. So IPAs in North Texas have been proposing prospective payments to commercial insurers such that they can get paid up front, still take care of those patients, and keep practices open in light of these shifts in activity. Next slide. So in brief, the purpose of this conversation today is to bring to surface really important questions that you're going to start having to answer for your practice. And I don't think this is, new information. Telemedicine is here to stay. In addition to telemedicine, you're seeing remote physiological monitoring, remote patient monitoring become a source of revenue, ultimately a new revenue stream for primary care practices. However, many are still curious about the coding for these services, and understanding how to code for these services is going to be more and more important as we see these changes with patient behavior in terms of how they consume healthcare really kind of settle in over the next few months here. And naturally, in addition to that, the notion of pandemic proofing the practice is going to be a much more appealing kind of way to think about the practice from a financial viability standpoint. And ultimately, to do so, practice owners are going to have to equip their operations with an analytics infrastructure that can study the cost and strategically adopt.
Like, I'm working. I be like, oh, okay. I love work.
Yeah.
Please mute yourself.
I know that a lot of people kind of came in as this presentation is wrapping up, but I always like to give the opportunity for questions, concerns, or comments. Any questions?
Oh, yes, I thought you started at 9 o'clock. Sorry. This is Dr. Oyemade. I just barely heard the last part of your presentation on telemedicine. I was also interested, actually, in the financial aspect of selling your practice. I don't know if you've already done that.
No,
that presentation
that's the next presentation
coming up. Yeah.
Oh, okay. That's good. Thank you.
Oh, no problem. Actually, any other questions?
Does anybody have any question for Dr. Wamba? All right. So we're going to transition to selling and acquiring your practice. So give me 1 minute and let me load the slides again, okay? Annie, are you ready to go?
I am ready to go if you can hear me.
We can hear you, and you should be able to see your slides.
Excellent.
Okay, so
thank you very much.
Okay.
Go ahead.
So this is Annie. Annie is the founder and chief investment officer for Wealth RX for Doctors. I will let him introduce himself and his team.
Well, thank you very much, Stanley. Good morning, Anpa members. Thank you again for joining us today for another invaluable financial intelligence briefing. This is sponsored by your Anpa under Stanley's great collaborative leadership. I have to say that Anpa is building a body of work, resources, and intellectual property that you as members can tap into as a benefit of your membership. I'm also fully aware that membership calls for a financial commitment and active involvement. I invite your participation in Anpa's mission. Anpa is making an impact and a difference, and I thank you. We thank you. Wealth RX for Doctors is your prescription for financial health, your lifetime wellness, and legacy. We're a rigorously assembled team of multidisciplinary specialists providing doctors an integrated estate planning, tax planning, risk management, income and investment planning platform. The last several weeks, Anpa has brought you several health-related and financially timely subjects to ensure your safety, financial survival, and solvency. Last week, we talk about retirement strategies and solutions, asset protection, and income replacement. The key takeaways for those of you who attended were: 1, you need a plan. This plan must integrate 5 key purposeful planning pillars: estate planning, tax planning, risk management, income and investment planning. The message was protect the asset. You, doctor, are the money machine, and your capacity to earn is your most valuable asset. Therefore, my friends, you must protect the asset. You must protect the asset in order to realize the benefit of our topic today: selling your practice, challenges, options, and tax-efficient solutions. As you know, WealthRx differentiates by giving you access to subject matter experts and practitioners. We differentiate by specialized expertise, and today is no different. We're bringing you 2 of the top national experts on the subject of selling your practice as a physician and succession planning, Mr. Rick J. and Mr. Jeremy Hewish. By the way, my tease of Jeremy for you is he is not Jewish, he is Hewish. Rick and Jeremy have very direct expertise working with doctors, with physicians, physician practices, and healthcare institutions. Stanley, I'm going to have you tee up the video,
Okay.
and then I'm going to turn it over to Rick. Thank you.
Give me 1 minute.
Dr. Kerr, while you're putting that up, I'll just begin with a sort of an introduction to give everybody an idea of our firm and our background, and obviously our affiliation with Inyi and his organization. So as Inyi had mentioned, my name is Rick J. I actually run the East Coast for a firm called BTA Business Transition Advisors, which is a division of a firm called Capstone Headwater, which is over the last 12 years is either number 1 or number 2 in the investment banking mergers and acquisition market of what they call mid-market companies, which are companies under $500 million in valuation. So we are a national firm. We're actually an international firm. I run the East Coast. Jeremy runs the West Coast. So I asked him to participate today because you're a national organization, and also because of his incredible background. Jeremy is both a JD with a master's in taxation from Georgetown, along with a CPA. So he brings a different level of intellectual capacity than most in our industry, because not only does he have an investment banking and M&A background, but he also has a tremendous tax background. And so part of what we're going to talk about today is, as a physician, and it seems like, and I'm new to your organization, you also have dentists that are members of your organization and other healthcare providers. Is that true?
That's true.
Yep. So the positive, we're going to talk a little bit about the dynamics of the differences then between selling a medical practice and a dental practice, and we'll sort of allude to that. We don't have slides that are specific, but we can talk a little bit about the dynamics and the differences, because there is a major difference between the value of a dental practice and ultimately the value of a medical practice. And unfortunately, from our prior presenter, and I hope I get the pronunciation right, Nwaba, Dr. Nwaba, is that correct?
Mwamba.
Dr. Mwamba, the positive that he alluded to, and again, having family in healthcare and being around it for over 32 years, I'm quite familiar with what has taken place. And unfortunately, over my career of 32 years in the industry, I've seen the healthcare industry, primarily the physician marketplace, that has gone from having tremendous, what I call equity value in the business that can be sold when a physician is ready to retire, to today, which is it's a wonderful job, and it's a wonderful way of giving back and taking care of patients. But I don't see physicians today getting rich off the value of their practices anymore, which is why it's important to work with somebody like Inyi to manage their assets. Okay.
All right, I'm ready for the video. Inyi, there you go.
Thank you.
So So I'm going to turn it over to Jeremy for to start. Let him give you a little bit of his background.
Let me know if that new prescription is easier on his stomach.
Thank you, doctor.
I saw Dominic Chile this morning during rounds. He's recovering from the surgery just fine. Nice little boy. He spiked a fever last night, but it's down again today.
Good. Was his mom there?
Yes, Joan. She's very nice. And I understand her husband is your attorney?
Yes, Ron. He's a wonderful guy, too, and a great lawyer. He was instrumental in that Pierce case. I'm glad we got through that. What a mess.
That case could have really hurt this practice, right? And I understand the Pierce boy wasn't even our patient. I think Dr. Jeffries only consulted with his surgeon on a referral, but all the partners were named in the suit.
Exactly. You know, the system doesn't seem fair at times. It's a good thing we have a strong legal and advisory team.
Brenda, can I ask you a related question?
Of course.
I'm trying to manage my med school loans, my buy-in to the practice, and my other finances, including John and the kids. I think I could use some help. Do you have someone you can recommend?
You know, when Jim and I first went into practice, we never thought that hard about any of that. I wish someone had brought it to my attention back then. I often wondered what would happen as our practice matured. But now look at us. Your buy-in is part of my retirement. Yeah, we've learned a lot over the years. Practice management, asset protection, malpractice insurance, benefits, consultants, even EPLI. And Susan, you can't neglect any of it.
The business side of medicine.
A very necessary side of medicine, trust me. Oh, and yes, I do know a fellow I can recommend for you. He's a financial services professional, and he really knows this business. And he gets along well with Ron and our CPA. His number is back in my office. Oh, and Sue, do me a favor. Why don't you rethink the skydiving? Give John some peace of mind.
I've got quite a few things to reconsider.
All right.
Thank you, Jeremy. Go ahead.
Well, great. Well, thank you. It's an honor and a privilege to be here and speak to you. Who's going to control the slide deck?
I'm going to control the slides. Give me a minute.
Great. Well, I'll give my background. Well, I am a tax attorney, licensed as a CPA and an attorney in the state of Arizona, but I have a national practice. I started out at one of the big four accounting firms, worked there for several years in Washington, D.C., done some lobbying work on Capitol Hill with certain congressmen and senators, and met with the IRS Chief Counsel's office and Joint Committee on Tax. And so it's always interesting stories when you go meet at the top tax writers in the country. But today we're talking about, obviously, at least this section of today's meeting, about selling medical practices. And I'm going to give some colorful commentary on some of the ins and outs on the taxes. And then my partner here, Rick J., he's going to give some more practical experience that he's done, having done probably hundreds of these in different formats. And so let's go to the next slide. Disclaimer here, as you can see, as you had one before. Next slide. So we've done introductions, and we're going to talk about, here it says 4 methods to sell a practice, and then we're probably going to add in maybe a 5th when we talk about some differences with dentists, what could be done. But we're going to march through traditional selling methods, the roll-ups, management companies, Esops, and then some concluding thoughts. And certainly if you have questions, I believe we have time at the end to take some of those. So let's go to the next slide. So what is the traditional method? And there's many ways to do it, but let me just go through the typical way. This is where you have a equity partner doctor, and it brings in, I'll call him a junior doctor. And that junior doctor starts at a salary, maybe there's a salary plus production bonus of some sort, but no equity stake in the business. And after a period of time, whether that's really short or could be 4 or 5 years, the junior doctor has the privilege to buy into an equity stake. And maybe it's just becoming a co-partner with the senior partner doctor, or maybe it's to take over the senior partner's practice and the senior partner retires. But usually that equity stake is somewhere around 1 year's worth of profits. And I'll explain what that could be in a second. It's not going to be a huge amount, but when I said nominal, it's still 1 year's worth of profits is a substantial amount. So let me put some very simple numbers, and your practice will have different ratios in this, but I'm trying to keep it as simple as possible. Let's say of every dollar of income earned in medical practice, 50 cents of it goes to overhead, 30 cents goes to the compensation of the junior doctor, just the normal doctor salary, and 20 cents goes to overhead. I mean, 20 cents is really the owner's profit. So the senior doctor, a dollar comes in, and that doctor makes really 50 cents. 30 cents is his or her normal compensation, and 20 cents is his profit. Plus, if you bring in a junior doctor, you get that junior doctor's 20 cents overhead profit until that person buys in, becomes an equity owner. And so now what happens is the junior doctor's there, and for 3, 4, 5 years works, and the senior doctor's collecting that overhead profit on them. And then when they do the buyout, then it's split between the two. Now, what's the taxation on this? There's actually 2 levels of tax that are going to occur, and that's important to understand what that's about. When the junior doctor, let's say the purchase price is 1 year's worth of income, which is 20%. Maybe it's going to be $100,000, just to keep it simple. So $100,000 is the purchase price to come on in. Well, that means that the junior doctor has to make probably about $170,000 worth of income, pay tax of $70,000, give $100,000 to the senior doctor to do an equity buy-in. The senior doctor takes that $100,000, pays long-term capital gain tax on it, will end up with about $70,000 in his or her pocket at the end of this. And so you have 2 layers of tax that occur when that happens. And the business had to generate about $170,000 worth of net income. After all the expenses, everything done, net income about $170,000. Then the first layer of tax is $70,000 paid by the junior doctor. So they have net cash to pay to the senior doctor, and the senior doctor pays long-term capital gain tax on that. And so it becomes very tax expensive, but that's just the way the standard buyout works, or when the new junior doctor comes on in. It's a very simple process. It has a lot of flexibility, so there's a lot of pros with it, but there's certainly some of the downsides that I see, and I'll turn over to Rick for some extra commentary. But while the pros are going to be, it's simple, it's very flexible, it has a lower buy-in price for the junior doctor, which is good for the junior doctors growing up. The downside is you only get about 1 year's worth of profits that are going to come to you as a senior doctor, and it's very tax inefficient on the way it is. And so, but again, for a lot of people, that's the right way. But Rick, other comments on this traditional method?
Yeah, I think, you hit it on the head, which is, what's gone on in medicine is because in physician practices today, there's not a lot of what we call declared goodwill, which is the value of your reputation, your name in the community, because for all intents and purposes, unless you're in a closed insurance panel, bottom line is if I graduate from medical school and open up a practice and get an opportunity of providing care under, whether it's United Healthcare or whether it's Blue Cross Blue Shield, I can do so immediately, hang a shingle, start advertising, and probably have a full flow of patients coming through the door very quickly. So in the medical world, as you described it, there's not a lot of tremendous value for the ability of buying in for that associate becoming an owner of the practice on the back end. Now, to twist that, in the dental world, now that I know that you've got dental members, in the dental world, there's tremendous equity value tied to goodwill. So it works in a very similar fashion under the traditional methodology. You recruit a young associate, they come out of dental school, or they're coming out of the military. They join your practice as an associate, and they work using the math that Jeremy just discussed. You generate a dollar of income. You've got 50% that is overhead, so you're netting 50%. You pay your associate 30%, and you net out 20% of that while they're associates. It's very common. And then on the back end, when they're ready to buy in, whether it's 5 years from now, 7 years from now, or 10 years from now, there's usually a negotiated time frame by which they're eligible to buy in. The value of the practice then gets valued, and there's an application in a dental practice to goodwill. So instead of being 1 times net income, it could very well be 2.5 times net income, or 1 times gross could very well be the value for the associate buying in at that point in time. And that would be a difference between not the way you do it, but simply the value differences between a dental practice and a medical practice today. So Jeremy, I'll turn it back over to you.
Great, thank you for that. So that's the traditional method. Let's move on and do some comparison to the next method. Roll-ups, we're gonna talk about roll-ups and then a separate management company, but Rick, would you talk about roll-ups and how those are gonna be structured?
Yeah, so for those of you that are a little bit older, you know, I'm 61 years old, so you get closer to my age, you've probably seen some of this. There's, you know, in the world of medicine, it's dynamically changed over the last 30 to 40 years, both in the way healthcare is provided and in the way that group practices have come to light. But when we talk about a roll-up, it's basically what we've seen in the industry at various cycles of sort of the economics associated with healthcare. The roll-up can be one of 3 things. Hospitals that are acquiring practices, because as you know in your communities, the hospitals want to control the patient flow. And so those who control the patients that are getting admitted to the hospitals are able to negotiate contracts differently than those that don't. So oftentimes hospitals become acquirers of internal medical practices, cardiology practices, and practices that tend to provide a tremendous amount of patient flow and oftentimes ancillary service referrals that the hospital can absorb and receive as technical fees. And the benefit for the physician in those is there's usually not a lot of money that you're going to receive from the sale, but the benefit to you is, as we heard before, you know, for those that don't want to be running a business, but want to actually be practicing medicine and caring for patients, when you become an employee of the hospital, when the hospital acquires your practice, the positive for you is you can work a 9 to 5 schedule. You can work, you know, 11 months a year, take a month off. You get paid a salary, you get bonuses. So you're working as an employee, but you're able to maintain more of a semblance of a normal life than when you're in private practice with the call schedules that you're typically on. So there can be advantages from that perspective. We've seen what they call single specialty roll-ups. So for those of you that are specialists, emergency room physicians, anesthesiologists, even cardiology, oncology, nephrology, the single specialty roll-ups are usually practices that have started off that are usually a little bit larger. They're single specialty in one of those areas. And what they've done is they've gone out and merged or acquired other single specialty groups that are mirrors of theirs, so other anesthesia groups. And what they're really looking to do is get economies of scale to negotiate stronger contracts with the hospitals. So they become the exclusive provider within a certain framework, within communities, within counties, so that they really can mandate and control the market, and it helps them in negotiating contracts, as you know, with various providers. So we see that. We've even seen some of those companies go public because when you get around a bunch of smart investment bankers, they think they can run medical practices and dental practices better than you can. Personally, I don't agree with that. I think you guys do a great job of running your practices and doing it effectively in combining both quality healthcare and managing the business. But with economies of scale and larger practices, there is some efficiencies that do come into play that can help drive greater profits, hence create greater profitability, therefore increasing the value of what the business is worth if you sell it out or you take it public. Then the last is, as you guys know, with Stark and what has happened with Stark 1 and Stark 2 over the years, and restrictions of markups for reimbursement, we still see today a lot of physicians have ownership either in partnering with other companies or partnering with the technical providers or partnering with the hospital in setting up things like MRI facilities, nephrology centers, kidney dialysis centers, outpatient surgical centers. And so the ability of selling those services and selling those entities on the back end can be a very lucrative approach, because the multiples that the hospital will pay to buy out the physician partners in the organization, or the multiples that get paid as a multiple of the profits of the company by the private equity firms that have helped finance those transactions, can be a massive windfall for the physicians that are partners. So, and the benefit in those types of transactions is different than having to earn income as the associate, pay taxes on the earnings to go ahead and buy it. It's a one form of taxation. It's simply capital gains tax that gets paid on the proceeds that are received by the physician when they're selling their practice ownership, when they're selling their practice to a single specialty roll-up, or they're selling their partnership interest in a outpatient surgical or dialysis center to the hospital or to a public or private equity group. So the positive in that case is they're going to get favorable capital gains treatment, assuming they've owned that investment or the practice for 1 year and 1 day. That can be very attractive. And it's one way that at least as a physician, you can get your equity value, which you deserve at the end of the road, of some form of equity value out of what you've worked hard your whole lifetime to build it. So with that, I'll turn it back over to Jeremy for the next slide.
That's right. Let's go on to management. So the management company strategy requires that you have a certain amount of size. You can't do a 1-man or 2-man or person medical practice generally and be big enough. You have to be big enough there so that you have several physicians as well as staff. And what happens is you form a separate company there that's going to have the contracts, perform the medical procedures, and then that management company is going to hire the physician and others to do the necessary medical services, pay the physician the amounts, and then it will keep the administrative and some of the overhead and profit at the management level. So essentially, the physician still gets the fair rate for wages, for compensation paid to them, so you're compliant with the rules there, but the profit's being stripped out to this separate management company. Now with the profit in this separate management company, now that, and it's being a certain size, you could potentially get a larger multiple than just 1 year's worth of profits. Maybe you can get 2 or 3 years worth of profits or 1 year's worth of gross. Again, it all depends on things. But this may, if you're big enough, this may be a strategy where that when you're ready to retire, you can sell your practice or be bought out by this management company, and it has enough assets and enough revenue in there to pay that higher purchase price, or the incoming, the associate physicians that want to buy in, they're going to be buying into the management practice. There's different ways it could be combined, but there's ways that this could potentially generate a higher than a 1x multiple. It'd be 2 or even 3x. So as far as non-financial considerations for many practices, you may not be big enough to get there, but for some, it's maybe something to explore, setting up this management company to do it. For the associate physicians that are coming up, know that this is going to take longer to buy out somebody else, the retiring physician or the senior physician, but that when you move into that position, you will also have a greater equity stake, it'll be worth more, and that hopefully when it's your turn to retire, that you can get the large payout as well. And so there's that pros with the management company. In contrast to the others, this takes more work to put together. It's more effort, potentially more profit. Certainly there's more economies of scale that can be done when you have several physicians operated by a management company. And it's when you're big enough, it's certainly something you should strongly consider. Rick, other comments on this?
Yeah, a couple things. One is this is a common strategy that you see both in the medical and the dental world, as you said, with larger practices, large multi-specialty, and even some of the large single specialty, where they separate out, the billing, the scheduling, the compliance, the oversight, and they break off. The only difference that I've historically seen is the physicians themselves are actually contracted they establish a separate entity or individual entities that are, depending on the state rules, PAs or PCs. So they're setting up professional service corps that they're providing their medical services through those entities, simply for, as you know, Jeremy, with your background, asset protection, providing services through, to some degree, through a corporation to give greater asset protection through that entity, and that entity then contracts to the management company. The other benefit to this is, there are some physicians over the years that I've met that ultimately decide, even early in their careers, to get away from practicing medicine on a day-to-day basis, but they love the business aspects. And so what this allows them to do is stop providing medical services, work and run or take an executive or management role, officer role within the management company, take on that responsibility and give up their day-to-day medical service professional work that they're doing, which can be a pretty effective way as they phase out in the future, and allow them to stay actively engaged in the business side of medicine without the requirements of practicing medicine. And so, and as I think you're going to get into the next step, which is what this strategy allows you to do uniquely, is it allows you then to create tremendous long-term into the road economic value that will be the difference for many physicians of retiring comfortably, or unfortunately having to work until the day they die simply because medicine hasn't provided them the ability of saving enough money to maintain their lifestyle during retirement. Because the next thing you're going to cover, this strategy is a mandate to allow it to take place. So with that, I'll turn it back over to you and let you go to the next slide.
Right. Next slide, please. So with the management company in place, you can now do an ESOP. Require that, a few minutes ago, I talked about the 2 layers of tax that were incurred in a normal buyout. Both the buyer has to earn ordinary income, pay tax on that of 37, 40, 45%, depends on your state. And then the seller has to also pay long-term capital gain tax on that. What if there is a way to do the buyout where you're not paying the 2 levels of tax, but potentially 0 tax on both sides? Well, what that would mean is that $170,000 worth of income that was earned by the company could now be distributed among the owners in a much more efficient manner than having to go through 2 layers of tax. So here's what can be done. So it's selling the management company to an ESOP. So what it is, so you have a separate management company takes over those profitable duties from the medical practice, and the company is then sold to an ESOP. So what is an ESOP? An ESOP is an employee stock ownership plan. It's a qualified plan regulated by the IRS and the Department of Labor. And what it allows you to do is to sell that profitable business, that management company, to the employees of that management company through special rules in the tax code that allows these employees to buy it on a tax favored basis. And so much like you could potentially get 2 or 3x or maybe even 4 or 5x, depends on the type of practice that you have and the value there. By doing this, there is ways that the seller, the selling physician, could make an election to pay 0 tax on the proceeds they get. And then the buying company, which is the ESOP, which is all the employees within the management company, they can potentially take a tax deduction for the principal there, and which means they're not having to pay tax on that profits that's made. They can use pre-tax dollars to buy out the departing physician. And so going back to the analogy, instead of having to make $170,000 to only put $70,000 into the departing physician's pocket, which causes $100,000 worth of tax friction, we can now earn $170,000 worth of profit, potentially pay all of that and maybe even more with some strategies, all that and maybe even more to the departing physician, and not have to pay tax at both the buyer and the seller level. So the details of how the ESOPs all work, we're just touching the high level now. That's a longer discussion, but this potentially can be the most powerful strategy to transfer the business ownership and to provide the most value to the departing physician there is through the ESOP company. So but unfortunately, it doesn't work for the smallest of practices. You have to be big enough to have that management company in probably a couple $1 million, maybe $1 million at the low end, to justify it. But for those that are big enough, absolutely is the best strategy out there. Rick, before I get into the financial comparison next chart, any more comments on the ESOP?
No, just one point would be, again, we talked about both physicians and dentists. Actually, one of the largest dental management companies in the country, headquartered out of, I believe, Iowa. It's a national firm, is an actual ESOP. And the benefit is they've been able to grow because of what Jeremy has just alluded to, the tax efficiency. The fact that not only is the ability for them to buy practices as they've grown around the country with tax deductible dollars or tax-free money, but the selling physician or selling dentist is able to receive the proceeds on a tax-free basis. So it's beneficial on both sides, which makes it easier. If I'm looking as an associate to buy a dental practice and I've got to compete with a company that doesn't pay taxes, the challenge is I'm most likely not going to be able to afford to compete to buy that practice. So they've been able to grow on a national basis rather quickly from that from the tax benefits that you're alluding to. And I think the next slide you're going to show kind of gives a comparison from the nature of the differences in the economics.
Next slide, please.
One more, please. That's it.
Okay, so this is, actually, let me go back one slide and just give a background on where these numbers come from. These are hypotheticals, and I kept them similar. So this is not a small practice. This is a middle market size practice there. The practice generates $2 million a year of profits to the ownership group. Well, it's one owner or many owners, but it generates $2 million of profit. The business is 100% sold to buyer by either cash paid by the buyer, a combination of cash and a seller note. Maybe there's different ways to do that. And the financial results look at the cash received and taxes paid by each party over a 5-year period, starting on the date of sale. Why that's important is I'm going to ignore all the associates. You know, when the associate has to work for 4 or 5 years before they can buy in, I'm going to ignore that time in this. I'm just looking at date of sale going forward 5 years, what's happening, who gets what money, where the taxes paid. And so if the purchase price here is going to be 1 year profit for traditional method. If you're doing a roll-up or management company, 3 years worth of profit. Esop, also 3 years worth of profit. Trying to keep in the assumptions very simple. Now let's go to the next slide and look at how this plays out. So there's two conclusions. One is the amount to the seller. The other one is the amount to the buyer. So let's look at that traditional method, management company and roll-up, and then Esop. And management company, also that's the roll-up side too. So just know they're both within that middle column. In the traditional method, the seller gets $2 million for a 1 year's worth of profits, pays long-term capital gain tax. I'm just assuming 25%. I know federal's less than that plus state, but just to keep it simple. So the net to the seller's pocket is $1.5 million. And if you're doing a management company, assuming you could get a larger multiple, maybe that's $6 million. You're paying $1.5 million, and that's 4.5 million. And then the Esop company, there's a couple ways to do this. We can make an election to pay tax as a seller, and there's some ways where you don't want to make the election. And that's a more advanced strategy where you want to participate on the ownership side, on the back side. But let's just say here they are not making the election to pay no tax on the proceeds. They're no worse off than the management company. They would still do it. But just know with the Esop, there's what's called 1042. It's an election where they can avoid that $1.5 million of tax and buy some other qualified replacement property and just defer it. Now let's look at the amount to the buyer. Now the buyer over the next 5 years would make $10 million worth of income. That's $2 million a year. The buyer would pay ordinary income tax of $4 million under the traditional method. Would have $6 million left over net of tax, would pay $2 million over to the seller and have $4 million left over. And so you make $10 million, you pay out 4 in taxes, pay out 2 for the purchase price, and have 4 left over. In the management company, you make $10 million worth of profit over the next 5 years, pay tax of $4 million, have $6 million left over, pay a purchase price of $6 million. So then you have 0 left over. And that's just the function of a higher purchase price. And so in the management company, you can see that the seller makes quite a bit more. They get 3 years worth of earnings versus 1 year's. And then the ESOP, what happens is you can have 5 years worth of income. You take a deduction for it as you when it comes in and pay no tax on it. And then you can pay $6 million of that to the buyer. And then you have $4 million left over. And so certainly the ESOP is the most tax efficient of the 3, and there's pros and cons to each of them. But if you're saying, hey, I've got the opportunity to do all 3 of these, which one should I choose? Well, we're going to be looking at this ESOP one on the far right corner because you're going to save millions of dollars in taxes by going the way where you can potentially avoid any taxes on the seller and the buyer's not having to use after-tax dollars to do the buyout. And there's Rick, you want to add some color on this?
Well, I guess the only thing I would say is, again, when you're practicing healthcare, fundamentally, the unfortunate side is today, and for quite some time, it's important to do quality planning, which Inyi and his organization do a great job of doing that along the way to help minimize taxes, plan for the future, save as much money as you possibly can. But the key is take advantage of the most effective opportunity on the back end as a physician or as a dentist to create as much liquidity as you possibly can on selling whatever the value is that is deemed to be what the value is of your practice. And when the timing is right, there is no perfect strategy, whether a traditional methodology, whether a roll up, whether a management buyout, whether a transition and sale to the hospital, or an ESOP. The key is, what are your goals and objectives? What kind of practice do you have? Is it, are you a sole practitioner? Are you in a group? Is it a single specialty or multi-specialty? Is it a large enough practice where a management concept makes sense? Bottom line is, don't lose the opportunity of creating economic value for yourself on the back end. Take full advantage of what it is to the best of what the law allows, based on your circumstances and your goals and objectives. And that's really what we're trying to identify today. There is no perfect strategy for you. It's what works. But don't give up the opportunity of just walking away from your practice and leaving it behind when there's economic value that can be retained, that can enhance your retirement, and ultimately, if you don't need it, enhance that of your children, or use it from a charitable perspective to give back within your communities. So with that is, I think we've covered this at a very high level. Jeremy did a great job. Again, Jeremy Hewish runs the West Coast for our firm. I run the East Coast, and I know as a national firm, you've got a presence throughout the country. But what questions do you have, if any, that we can answer for you at this point in time?
Thank you very much for the excellent presentation on practice acquisition. I did have received some questions. Can you expand on the management? I'm assuming that's an MSO that you're referring to, right? The management service organization?
Absolutely, yes.
And number two was, in terms of you keep referring to the minimum. What's the minimum amount? Is it on the amount of doctors or an amount of income, profit you need to have an MSO?
That's a great question. It's really, it's more on the line of how much. What I've seen is it's more on the line of the total revenue, total billings that are taking place within the practice. What we usually see for an MSO to really make sense is you're usually looking at least 10 physicians that justify the support of the overhead to create the MSO, and to be able to hopefully use the leverage of the MSO and the number of physicians within your communities to negotiate better reimbursement contracts with some of the insurance carriers. And that really depends on where you are, where your practice is located, the communities that you're in, and the size of those communities itself, and then how many hospitals are within the community itself. So a lot plays into it, and I don't know if I answered it directly, but size is critical just because the cost associated with constructing the MSO and the ongoing cost to operate an MSO, if there's not enough revenue that is driven, there's not enough profits that are driven within the MSO to justify that type of organization.
The second question I have was, for the MSO, who can own an MSO, and can it be used as an asset protection for the physician's family?
Jeremy, you want to take a whack at that first?
Well, it's going to vary by state, but certainly the physicians can own it. And in many states, if we can keep the medical fees for physicians, you could have non-physicians own the MSO as well, or be partners in it. But you'd want to look at the state, but you could have non-physicians that are there, which gets into what Rick talked about earlier is you got private equity firms may want to come in and start to buy some of these, which is a lot of recurring revenue that happens. And then certainly you could have the ESOP be the owner of it, where you create the MSO and then eventually you sell it to the ESOP, and now you have this tax-free employee stock ownership plan that owns it. So you have flexibility on who it is, but it's going to be a state-by-state look.
There's another question on the chat. You can also feel free to ask the question yourself as well. The last question I have was, could you give an idea of selling costs to hospitals? I guess this person is referring to selling their practice to the hospital.
Yeah. In a prior life, I had a lot of experience in doing that and helping organizations, medical organizations, negotiate terms and conditions to sell their practices. And in reality, I'm going to give you some wide ranges of a cost. You need to have legal representation, first and foremost, that's going to review the sale agreement, along with the conditions and provisions that are going to provide ongoing employment agreements for the selling physician, which obviously is oftentimes part of the criteria. But I would say round numbers, if you've got a single practice as an internist and you're migrating to sell your practice to the hospital, you'd be looking at fees, depending on where you're located, of both combination consulting and legal fees of somewhere between $50,000 to $100,000. I will also tell you, oftentimes we've been able to negotiate the hospital in the past where we've represented the client. The hospital has actually paid and provided reimbursement to the physician for the cost associated with the transaction. So don't be afraid of the fees early in the discussion. Your consultant, whoever you'd have to represent you, or legal representation, could very well negotiate the cost reimbursement back to the physician of any cost they incurred to do the transaction. And that's common to what we see on these transactions.
Okay. Any other questions for our panelists?
This is Chris Stanley. I want to say a big thank you to Jeremy and Jeremy's team, especially for including the whole dental practice in this conversation. It just helps me to recognize that your group also recognize that apart from physicians, we have dentists in the group. So my question to you, with the DSOs, you talk about the MSOs in medical practice, and you also alluded to the DSOs, the dental service organizations. And the question is, you talked about size. When you talk about MSOs, you talk about DSOs, size matters. What do you see the future of DSOs in terms of dental practice at this point? From your exposure to the DSOs, do you see sole practitioners being kind of out of the business and now going more into DSOs, or what's your perspective at this point?
I'm going to give you again, it's all opinion, and I do a lot of consulting still in the dental world, so I think I've got a good basis of understanding. The one big advantage of dentistry over medicine is, in dentistry, as a dentist, whether you're a general dentist, cosmetic dentist, endodontist, orthodontist, or oral surgeon, for all intents and purposes, there are still dental practices that accept no reimbursement from insurance providers. And so the byproduct of that is, I think for years to come, there is a space for solo practitioner dental practices to thrive, to continue providing services, irrespective of insurance reimbursement, capitation, or other insurance type programs, for dentists, solo practitioner dentists, or small groups to continue doing incredibly well from a net income perspective, and ultimately build up tremendous value, getting back to the idea of why dental practices have higher valuation at the time of sale. Because as a single specialty dental practice, or even a larger multi-specialty, which is oftentimes when you get into the DSO type organizations. I live in Florida. There's a large group down here, a DSO organization called Greenberg Clinic, which is a multi-specialty dental group throughout the entire Southeast. And so, but the idea is your question about, where is it going to go? I don't think it's going to change, and I don't think DSO organizations are going to be the controlling provider in the industry. I think there's a space, and will always be a space, for fee-for-service, non-insurance-based dental practices, and those will be the areas where the dentists that are in those practices will build up tremendous long-term value in their practice and be able to reap the rewards of the sale through a goodwill transition and sale of that practice at the end of the road. And again, in dentistry, it's unique in the context that you got reoccurring revenue. If you're a general dentist, for the right type of dental practice, there is a tremendous amount of annual income and profits that can be generated from pro fees, cleanings, and examinations that oftentimes are not available in the world of medicine. And so for that, I think DSOs are here. I think they're here to stay. But those that are making money in the DSOs are not the dentist individually. In the DSO organizations, it's the owners of the DSOs, which are either non-dentists, investment bankers, or their dentists that were business owners and saw the opportunity of setting up the DSO, acquiring practices, buying them, and hiring associates that they pay them a percentage of what the overall net profits are that they generate, and then build it up as a business, not worrying about the level of care that is really being provided. So long-winded, I apologize, but hopefully that answers your question.
You clearly answered my question, and I thank you for your experience and expertise. So be rest assured, you're going to get some dentists reach out to you from this group. Thank you very much.
Thank you.
Dr. Okoro?
Any other comments? Dr. Wamba is still online. Do you have any closing comments as well?
I'd like to thank everyone for their time. These were some great presentations, and I look forward to participating again in the future.
I'd like to use the opportunity to thank all the presenters for staying on time. We were able to finish everything in 1 hour, and I will encourage our members to reach out to the presenters for more information. Dr. Okuru, do you want to conclude?
So I thank Dr. Okoro for continuing to put this webinar together. I see that members continue to see value in these presentations that you have been putting together. But at the same time, I want to thank all the presenters. It's been an exciting moment for me, and I think for all members who have attended. We continue to get insight into how we practice, whether you have a private office or you work in a big healthcare organization. We are seeing value in how you are bringing us up to speed, especially with the COVID-19. So on behalf of the Association of Nigerian Physicians in the Americas, I want to say thank you to you presenters and to all members who have been engaged and asking questions at this point. Thank you very much.
Thank you.
Thank you. Have a wonderful Saturday and stay safe, guys. Thank you.
Thank you.
Thanks, everyone.
Awesome. Thank you.
Vale.